Yeah, so there are 12 people in attendance can maybe as we continue, a few more others will join. So let's get started. So we're going to continue from where we got to last week. And last week we were talking about what's it called? Candlestick anatomy. And we did that for bullish candlestick. So today we're going to do for bearish candlestick. You might be hearing the course of the webinar, you might be hearing the screams of the sounds of that's my daughter. The babies are very that. Right. So, like I said last week, we are going to use the default colors for a bullish candlestick are green and white, whilst that for a bearish candlestick while those for a bearish candlestick are red and black. But then I said we're going to settle on green for the bullish candlestick and red for a bearish candlestick. But you can decide to use whatever color you want. You can customize your chart to look whichever way you want. But for the purpose of what I'm doing here, I'm going to stick to green and red. So we did green last week, we are coming to red. Bearish candlesticks. So how do bearish candlesticks form? Like I was saying, the candlestick is like the cell of the human body. So the candlestick is like the building of the market. If you are looking at the candlestick charts, so it's important for you to understand how these candlesticks form individually, because that can go a long way to help you understand bullish markets and bearish markets. And I proved it last week with a few examples for the bullish one. All right, so from the lesson we had, was the last week or when? I said when you hear the word bearish, I already explained. We are talking about downward movement. The bullish, we are talking of upward, but we're already down with the bullish candlestick. So bearish is downward movement in the market. So if we say a candlestick is bearish, it means that the candlestick forms the closes at the bottom. So some people, instead of saying bearish candlestick, say down close candle. And instead of saying bullish candlestick, they say up close candle. It's very simple. Down close candle because it closes at the bottom. It's as simple as that. So how does it form? And like I said last week, every candlestick you are looking at, every single candlestick you look at in the market, is giving you 4 pieces of information. The price at which is opened, the highest price it went to, the lowest price it went to, and the price at which it closed. And the bearish candlestick is not different. So opens like this. So these are open. Remember, the open is the opening price. Right opening price is from 2 close. So that's what I So when you see open, it's opening price. Because the candlestick opens at a certain price. Now, in most of the cases, when a candlestick opens, it doesn't go down. When a bearish candlestick opens, it doesn't go down. It goes up first from a high. So the high just happens the highest price. So if you are looking at a candlestick on a 1 hour time frame, is that within the 1 hour that the candlestick was formed, that high was the highest price the market went to. So the high is the highest price. Then it comes down. Comes down, it's getting ready to close, but that's close in most cases. It actually comes down. It actually comes down to form a low. So the low is the lowest price. Then if you are looking at a candlestick on a 1 hour time, is that within the 1 hour that candlestick formed, the low was the lowest price the market went to. Then it finally comes down when it goes. Everything that's like it's only God that does not have a beginning nor an end. Because it's infinite. Okay, come to also the structural view of it. So it opens to over here, goes up to form a high, comes all the way down to form. So I can finish. As simple as that. Opens, goes up to form a high, comes all the way down to form a low, and goes back up to form. It forms a structure like this. So it's open. It's low. Forms what we call open high, open high, low close. Now it's important to understand this because it can help you know it doesn't the candlesticks do not form with wicks all the time. Sometimes find candlesticks that form without an upper wick or a lower wick, or even both. You find a candlestick that has either an upper wick or a lower wick. But the thing is that most of the time candlesticks form with wicks. I can say like 60 to 70% of the time in the market, candlesticks form with wicks. You understand? That means that if you base your analysis on this concept, there's a likelihood that you will right 60 to 70% of the time. And those are really good numbers in this market. Really, really good numbers. So it's important to understand this. So when the candlestick opens, that's the beginning of the period within which the candlestick is formed. Okay? So if it's going to be a bearish candlestick, there's a really good chance that it will first of all go up to find a high. We call that the peak formation high within that period. Let me take that again. So when the candlestick opens, you have to understand that the opening of the candlestick is more or less the beginning of the candlestick. So if it's going to be a bearish candlestick, there's a really good chance that first of all go up to form a high. Listen to I'm selecting my words carefully. I'm using very specific words. I said there's a likelihood because we are dealing with probabilities. Personally, I do not use the words will, forex trade, or definitely forex trade. I don't use those words because everything we are doing here has to do with probabilities. But if you say something will happen, it means that we are certain that it's going to happen. If you say something is definitely going to happen, it means that you are certain that it's going to happen. But there is no certainty here. So in order not to unknowingly program my subconscious mind to believe in certainty as far as the forex market is concerned, I use words that suggest probability. Words like terms like there's a chance, there's a likelihood, or it may. You understand? So remove the words will, remove the word certainty from the vocabulary when it comes to forex because there's no certainty. Because if you don't, you get used to that idea, it hurts you psychologically. Because when you take a trade that is a losing trade, you beat yourself up because you don't understand why you lost it. That is because on a subconscious level, you believe that there is certainty here. So we are expecting to win every single trade. It is not healthy for your psychological development as a trader. So understand. So back to what I was saying. There's a really good chance that when a candlestick is opening, like when a bearish candlestick is forming, it will go up first. There's a chance that it will go up first before coming down. But like I said, there are times when the candlesticks do not have wicks. And if that's the case, when the period begins, you just see the candlestick going down, it doesn't go up to form a high. You get it? So on a typical bearish setting, let's say you analyze a certain pair and it has a lot of bearish sentiment, and it is going to be bearish this week. Well, let me show you something. Let me do some illustration. And it's going to be bearish this week. Okay, so this is Monday, Tuesday, Wednesday, 1, 2, 3, 4. One more. So this is Monday, Tuesday, Wednesday, Thursday, Friday. So we are looking at, so this is the whole, there are 5 trading days. Okay. So on the daily time frame, on the weekly time frame, what you see is the formation of a single bearish candlestick. The typical bearish week. On the weekly time frame, what you see is a single, what you see is the formation of a single bearish candlestick. So this is Monday. This is Monday. Tuesday. Wednesday. Wednesday. This is Friday. So since on the weekly time frame, a single, since on the weekly time frame, a single bullish episode bearish candlestick is forming. And look how the bearish candlestick is forming on a typical bearish like this. Open high, low close. So what does that mean? It means that at the beginning of the week, you should be expecting what? Upward movement. So if I were you, what I'll be doing when Monday comes is to observe and look for liquidity. And then to look for those of you who don't know liquidity, no worry, we'll talk about it when we get to the levels. And then to look for a resistance level above it. So on Monday, this is what you are likely to see. A bullish day. So it opens, forms a low, and it goes up, trades, and probably comes down for a close. Now, what I've observed is that mostly the peak formation high and the peak formation was formed on Tuesdays. A lot of the time, I can say like, let's say 60% of the time. And in Forex, if something is happening 60% of the time, that's very good for you. So, say Tuesday goes up to find a high, then it trades and closes as a bearish market. Wednesday comes, it goes back up. So let's see the resistance level here. Then it trades, closes as a bearish market. Okay, closes like this. Then Thursday comes, it goes back. Sometimes the reversal will start on Thursday, but most of the time it's Friday. Okay, then it trades down and it comes like this. Then Friday, it takes liquidity via support. So Friday, you are likely to see a reversal. Sometimes it will reverse back to the price at which it opened. I'm going to show you examples. You understand? So on a typical bearish, okay, I'll be looking for sales on Tuesday, on Wednesday, and probably on Thursday. It depends on some things I'll look out for some, because sometimes the reversal starts on Thursday. So if the market is typically bearish, selling on a Friday is a bad idea. Why? Because on the weekly time frame, the bearish candlestick form and it is closing. So what's likely to happen? The market is likely to go up for a close. And this happens a lot of the time in the market. Not all the time. Let's be careful. Not all the time, but a lot of the time, this happens. A lot of the time, this happens. Why? Because of the formation of the bearish candlestick. So This is how bearish candlesticks form. Open, high, low. So this is the beginning of the period. So let's see Monday up into Tuesday. Sometimes the big formation high will form on a Wednesday. It can form basically on any day, but mostly it likes to form on a Tuesday. I can say like 60% of it. So it forms a high, then it sells throughout the week, and towards the end of the week, what does it goes back down for close. That is how it's likely to play out. So I will show you some examples. So this is very, very important to notice. So let me ask, do you understand the anatomy of the bearish candlestick? If you understand the type, yes, so go on to the next. Type yes if you understood what I is. Okay, so let's look for examples. Let's. This pair was bearish last week. This is against the candle. So let's go to the weekly time. So if we go to the weekly time frame, each candlestick has go on to form. So this was the last. This week just began. So it's Tuesday. So we're looking at this candlestick, last week's candlestick, this one. So let me see if I can highlight it. How do I highlight it without all the others? Let me see. Look at the candlestick. I don't think highlighting it, but I'll still find a way to show you. So this is it. You see, obviously this was a bearish candlestick. Last week was bearish for USD card. Look. So it opened here. This was the open price. It opened at this price. It didn't go down. It went up to find a high. It came all the way down before we go. And then come back up for the close. So on the weekly time frame, the whole bullish candlestick was formed. Now we can go into the weekly time frame and then look at it from an intra-weekly level before we even go and look at the intraday movement. How do we do that? We place vertical lines on the candlesticks and then we go down to the 4-hour time frame. Let's go to 4-hour. So this is how it looks like on the 4-hour time frame. It's open here, went up to form a high, came all the way down to form a on Friday. Look at what happened, how it looks on Friday. It went up. See the structure? Open, high, low, close. High, low. So let me do this. There's a line that I want to go. That was I should have left that on maybe. So now let's go to our 1-hour time. We're coming to look at it on an intraday basis. When you want to look at something on an intraday basis, you go to 1-hour time and then you right click on trading, right click, come to settings, come to events, and go to session groups. And click OK. So you divide yesterday was Monday. So this was last week Friday, last week Thursday, last week Wednesday, last week Tuesday, last week Monday. So let's look at it. So this was Monday. On Monday, we didn't see much movement. The market was more or less consolidated. But this was one of the days when the high of the this was one of the weeks when the high of the week formed on the Monday and not the Tuesday. So it formed on the Monday. Yeah. So Monday there was consolidation. So I'll not really consider that. But Tuesday comes, look at it. It goes up to form a high, and then it is all the way down. Look, it is all the way down. Tuesday. So if I'm looking for sales, I'm looking for to take my trades on Tuesday. So it goes up to form a high, and the trades all the way down. Wednesday goes up to form another high, trades all the way down. Don't bother yourselves too much about this movement. So that is something we are coming to do at the market structure. That will be on our next lesson. So this was Monday, not much movement. Tuesday, we saw sales. Wednesday, we saw sales. Thursday, we saw sales. Then guess what happened on Friday? Why? Why did we see buyers on Friday? Simply because the week was weekend and the the bearish candlestick was closing. So we had to go back up for a close. It's as simple as that. You understand? Let me see if I can find another example of this. Let's go to the bearish. Or you know what, let's look for bullish examples because we've done the bullish candlestick already. So let's do for bullish examples and we'll look for more selling. So for NZD-US, let's look at last week candlestick. This was last week. So remember how the bullish candlesticks form. Open, it open here, it come down to form a low, go all the way up to form a high, then come back down. But look at the previous week. There was no wick. The fact that there's no wick does not mean there was no low. There was a low, just that the low and the opening price were the same price. This is one of the examples I was talking of where there's no low. So on this week, the market didn't come down to form a low. The price at which it turned out to be the same as the low. So it just went up. But look at last week, open came down to form a low. So this is a structure for a bullish candlestick. I hope you remember from last week. Open low, high, was a bearish one this one. Open high, low, close. No let distance confusion. Open low, high. So open low, high, close means that. But the typical, when I say typical, it means that the candlestick forms weeks. So the typical bullish week, beginning of the week, Monday, Tuesday, we are likely to see sales. Tuesday, Wednesday, Thursday, we are likely to see serious buyers. Then Friday, we are likely to see close. So let's see what happens. Now, let's go straight to our data. So this is this week. This is today. This was yesterday. So let's go back to last 2 weeks. Last week, sorry. So this was Friday, Thursday, Wednesday, Tuesday, Monday. So look at something. So this was Monday. So you see what happened on Monday. The beginning of the day, that was with the Asian session. The market came down, came to form a low, went up to close. You see, came down to form the low. That low happens to be the same as the low for the following week, which was Tuesday. So Tuesday, the market came back there for yet another low. You understand? And then what happened? So you see, spent the beginning of the week coming down to form. That's because on the weekly time frame, this was happening. Open low, high close, the bullish candlestick comes out to form. So Monday, Tuesday, low is formed. Look at what happens on Wednesday. Bullish movement. So on Tuesday, we have bullishness. Wednesday, bullishness. Thursday, bullishness. Friday, the end of the week, what happens? Because on dates and later but it comes down for because on Friday, it sold for about from this high to that low. This high. That low. It's about what is an abuse? You understand? So these things tend to play out a lot of the time. Because a lot of the time, find candlesticks that form the way I'm trying to explain to you. Let's look at your motives. If there's an example there too. So last week, US was very, very bullish. So it was Friday, Thursday. So on Friday, it just consolidated. Didn't really do much. But most of the movement was from Tuesday. So this is Friday, last week, Thursday, Wednesday, Tuesday, Monday. So look, Monday, it comes out from the low. In many of these cases, the low was from the Monday. That's nice. Monday, it came down from the low. You see, as soon as the low was established, somewhere around the somewhat level, Tuesday comes, movement upward. Then the movement. Friday, it was supposed to come down for the close, but it struggled a little, so it just consolidated. That was how it used. Similar thing for. So these things are very important for you to understand because your ability to understand them can play a very important role in your profitability. And this market, I've been saying, is not a random market. It has been designed to work in a certain way. Now, if we do not understand it, looks like the way is against us. Then you hear traders saying things like, oh, they manipulated the market. Traders always want to blame everybody else for their losses but themselves. When they lose, the broker caused it, the market caused it, MTN caused it, Vodafone caused it. I'm not saying MTN or Vodafone cannot cause. MTN has actually done that before. That was in 2020. I was at about $130 profit. And I wanted to close that night because news was coming. You know, the SNT they usually have their news comes. The news was around 12. I tried closing this thing, it wasn't closing. Then I switched to Vodafone, it wasn't closing. But now that I work with a broker, I want to believe that that broker was that time it was that was the first broker in Twitter. That was 2017, 2018. I want to believe that they intentionally froze their terminal. Now that I'm working with a broker and I've seen that other brokers do stuff like that, I think it was not MTN or Vodafone. They actually did freeze the terminal. But I couldn't close the trade. Then when the news passed, I was now able to close. I ended up closing for a loss of about $260. Something that was giving me over $100 profit that I wanted to use. The terminal froze, I couldn't use it. And I blamed it on MTN and Vodafone. Now that I'm much more experienced in the market, I know that it was the terminal that froze. Yes. And let's do that a lot. I'm not saying this to discredit them or to sabotage them because I was hurting markets. I'm just stating facts. I'm just stating some facts. So that was what happened. So, like I was saying, traders tend to blame everybody for their losses by themselves. This person, the broker caused it. The market caused it. They manipulated the market against. But my guy, there were other people who doing this big money. So is the market fresh? Those people are. It's you, it's not the market. And it's a very dangerous way to go about life. Because if you go about life thinking like a victim, the most dangerous thing about it is you will never see yourself to be the problem. In your mind, other people are responsible for the problems. But if you take your time and say to yourself and real introspection, you realize that you are the cause of the problem. But because you have a victim's mentality, everybody else is responsible for my problem. I always tell people that even if witches succeed against you, it is your fault. Because maybe you're not prayerful enough. You're prayerful, the witches will succeed. I'm not saying that sometimes life cannot be unfair. Sometimes life is unfair. But most of the problems you have, if you sit down and look carefully, realize that you are the cause. I'm telling you, most of them. I'm not saying that other people cannot cause problems for them. I'm saying most of the problems in your life, if you sit down carefully and think about them, realize that you are the cause of most of them. So it is always important that we do an introspection to find out exactly what it is that we are doing wrong as far as trading is concerned. That can really help with the difference. You understand? Yeah. So that's the activity. Candlestick pattern. That's the introduction to technical analysis. So in our next lesson, we are going to do something very, very interesting. Something called market structure. Market structure is all you need in order to trade. You don't need anything else. If you understand market structure, you don't need any other strategy. You don't need to pay for anything from anyone. Just understand market structure. If you understand market structure, you don't need to understand. You don't need to understand harmonic patterns, Elliott waves, and all those things. All those things were coined for market structure. So understand market structure and save yourself from paying huge sums of money to other people for mentorship. Yeah. So that's one of the things you experience as a new trader who is very naive. Is jumping from mentor to mentor. You go and see this mentor, it teaches you a strategy. And then you use it. Your first few weeks of trading, you are making money from it. Then the losses come. Then in your mind, you are like, perhaps the strategy does not work anymore. Let me look for another one. Then you go and pay new money to a different mentor to teach you something else. Then he also teaches you the strategy. Then you use it. For a few weeks, you are making money. Then the losses come. Then you are like, this one is not working again. Then you go and get another mentor who also charges you and teaches you. You keep going round, spending a lot of money from mentor to mentor till it dawns on you that perhaps the strategy is not the problem, but the problem. That's why you get fed up with me. Pay people. Whatever. The truth is that everybody is teaching the same thing, but they don't realize it. They just do not realize it. Everybody is finding their own way of teaching the same thing. You understand? So, and when they do, they come up with catchy names. When you hear those names, you're like, wow, strategy correct. Then you go and pay money. So you hear stuff like the coding method. The coding method. And like, hey, coding method. I mean, I will make money pound. Then you go and learn it and realize that you have already known it. Somebody has taught you before. But this person has just checked it and added some one or two stuff. You understand? Everybody is the same thing in a different way. Because I always say that forex traders are like rappers. Every rapper claims he's the best. So every forex trader also claims he's the best. So he learns something and then he gives it a different name. Gives it a different name to make it look catchy. So that people pay for it. And then that is credited to you. A market structure is market structure. Once you understand market structure, you need to know anything else. That is what the market is about, market structure. And that is what we will our next lesson. So I've been treating all of you to really get ready for it and put in the effort to study it as you have been taught. Because market structure alone can make all the difference for you, because that is what the market is about. The market has a structure. How well you understand that structure? So we'll do that on Wednesday. On our next lesson. I can't tell if it will be on Wednesday or Thursday. We're supposed to have a webinar, but I had something to do, but I decided not to host the webinar because I was talking a lot. You know, when you're hosting, when you're teaching, you talk a lot. Talking is big work. Big work. So if you're not passionate about what you're teaching, there are some points But it will even take too long. You can't fed up with it. You don't want to beat it. It's not an easy job to say. Because usually when I finish hosting webinars, I feel like I'm beaten. Understand? But I like to teach Forex. Yeah. That's why I've been doing it for the past 3 years. Handtech on it. Before Handtech, I was doing it already. Give or take, I've been teaching Forex for like 4 years. Yeah, I started teaching Forex in 2019. Yeah, 4 years. No, I'm not fed up yet. Yeah, so I'll end there and then take your questions. If you have any questions, this is the right time to ask. So I quickly answer and we'll call it a day. Or any questions?